Well, our next guest says no matter what happens with earnings season, he is all in on this market. Let's bring in Jonathan Golub, Chief U.S. Equity Strategist at Credit Suisse. Jonathan, great to have you with us. What's your price target for the year now?
30.25, which when
30.25.
When I put it out, it sounded so exciting, and now it's like 4%.
It's not so. Are you going to revise higher? Because I mean, you want to go all in. You want to make the case to go all in for 4% upside.
Yeah, I mean, the truth is, I think that the real story here is I think that the market is not going to be constrained by relatively modest earnings, and that the surprise this year is that you're going to have okay earnings, an okay economic backdrop, and stocks are going to continue to re-rate anyway, which is what's been happening. And I think investors have been off sides on this because the earnings aren't spectacular and the economic data is not spectacular. But yet what you have is the Fed is out of the game. Recession risk looks like it's off the table. Trump isn't fighting on China. The volatility is down. And that backdrop is pushing stocks higher.
So is there a specific catalyst? It just sounds like you're thinking everything's going to be kind of okay, and so therefore it'll just be a drift.
Well, if there's a catalyst in the near term, it's that all of this conversation about an earnings recession, I think, is going to prove to be way off the mark. I mean, right now, the consensus view is that you have like a 2.5% contraction in earnings. First of all, first quarter beats tend to be the largest, about 5%. But more importantly, the average company or the median company is about 500 basis points stronger in terms of earnings growth than that weighted average number, partially because of taxes, partially because of oil prices. So I think that a portfolio manager is looking, chances are that the average company's portfolio is going to be up 7 to 8% on earnings. And I think that they're going to be saying what earnings recession, and that's the way it's going to feel. But there's no question. Some of these big tech names are a drag, energy's a drag, and taxes obviously year over year.
It's great that you're bullish, and that's your prerogative. But what's the bear case? Because I know you examine what can go wrong under this scenario.
Yeah, I mean, the biggest bear case is probably that we got lulled into complacency on inflation. I mean, one of the things I think that's driving the market higher is that wage inflation actually came down, consumer inflation came down, and there's a reason why everybody thinks the Fed is out, because it looks like this cycle is going to go on forever and inflation risk is off. If all of a sudden that reverses, that's probably the worst thing can happen. And if I look at the earnings data, I mean, there's a number of, we were talking about this before, Dan, there's a number of these big tech names that actually have some hair on them in terms of their cost line, and there's a possibility. Now, do I think that this quarter they're going to be a beat? I absolutely do, but maybe the expense is a little bit higher. Maybe you want to rotate not out of tech, but towards mid-cap tech away from the big caps, which would kind of change the tone of the market.
And so that's the bear scenario. Where could you be wrong that you underestimated where can the market go? What would be the most likely driver?
The one area that I kind of can't get my head around is all of the optimists are saying that there's going to be this magical second half rally because China's pouring on the kerosene, that Europe is like all set up to run to the upside, and we just get surprised that all of these bearish earnings estimates and the leading indicators and the PMIs are just way too negative. Do I buy that argument? I'm not sure I do, but if there was an upside scenario, it's that China actually lights up some of this stuff. And I mean, just look at the European banks, for example. You get a pickup in activity, and these things are going to rip.
What sectors do you want to be in this environment that you're seeing?
Right now, again, let's say if you look 1 to 3 months out, I think the big story is the hedge funds are still underexposed. Volatility came down. The hedge funds, because they got so beaten up in December, were a little bit reluctant to fully re-risk, and I think that means this is going to feel very pro-cyclical. So let's see, if you look within tech, it's hardware, it's semis. But as we move through the year, I think that cyclical trade rolls over. So I think that as the year progresses, it's going to be more like software over hardware. I think healthcare, which has had decent fundamentals but has been a dog on performance, I could actually see that turning around as we move past this kind of, this beta trade in the back half of the year.
Okay. We're almost at the back half of the year, by the way.
We are almost at the back half of the year.
I mean, it's not too much longer before this thing rolls over in terms of the sectors trades, not the markets.
Right.
Jonathan, thank you. Good to see you. Jonathan Golub
Thank you.
of Credit Suisse. Tim, how do you trade this?
Yeah, what's interesting, and I was looking at Jonathan's numbers. He sent around some charts, and basically the consensus is at 8.8% EPS growth in the fourth quarter. He's actually at 3.9, so a more moderate run. And if you think about where people have praised the last couple of years, everybody thought second half of 2018 was going to be the strong part. They knew the first half was going to be tough. It seems to be the same setup here, and it could also be wrong, because I think by the we get in the second half, we've either blasted the last of whatever kind of liquidity juice we can, or we actually have the Fed back in the picture. Something to be certain.
You added to healthcare today.
I did. I bought some Anthem today. I mean, we know managed care has just gotten annihilated over the last few weeks. This just seemed way, way, way overdone. We'll see in 2 weeks. I don't think earnings will be so indicative of anything, but maybe they'll talk about what they're seeing on the policy front.